Hi, this is Randy Finney with Right Side of the Chart, and today is Wednesday, March 14th, 2018. In this video, I wanted to share one of what I believe is the most useful tips in trading. It's something, an idea that I've shared many times over the years on the site for members within the trading room or in various posts, but it tends to get buried. And as we always have new subscribers coming into the site, I like to, I wanted to put this in video format, and then I will archive this under the educational category on right side of the chart, as well as in the YouTube channel. If you're watching this via YouTube, if you're not a member of the site, there's a section for educational posts, anything relating to trading tips or anything like that. So what we're going to talk about today are OCO orders. As the name implies up here, OCO order, it means one cancels the other. And it's very simple. Some brokers, keep in mind, refer to this as an OCA order. They call it one cancels another. Same thing. What it is, it just simply consists of two orders that when the first of the two is filled, doesn't matter which order, the other one's canceled. So what it allows you to do, and we'll use an example here. The most recent trade we had just closed out on right side of the chart on the SPY. We'll look at that and see how we could have how you could have used this tool to your advantage. Before I get into that trade, the benefits here are twofold. First and foremost, there's the time constraints. I know a lot of people out there are part-time traders or wanting to be or learning about trading or investing. And let me say this works equally as effective, and I recommend it just as much for long-term investors as I do for active traders. Whether you're a rookie, professional, I use these orders and I think they're great. So as far as time constraints, I know a lot of you do not have the luxury that I do of being a full-time trader and being in front of the computer all day. Others do. You might be retired and you have no desire to sit in a chair for 8 hours a day watching a bunch of monitors and looking at different charts and keeping a close eye on the market. So this allows you to set it and forget it. You buy a position and one of two things will happen. You'll either be protected if on the downside and limit your loss if your stop order is hit, or you'll hit your profit target on the upside. And I'll get to that in a second here, show you an example how to enter these. The other is, and I think this benefit is just as important, is discipline. From both my experience over the years, especially as a rookie trader, and in talking to a lot of people on the site, is discipline. They might get into a stock at the right time, although as soon as they see their profits start to go or the trade maybe pull back and they see it turning going against them, they second guess it and they pull the trigger too early. And if you if you traded, you probably know what I'm talking about that. And the other thing there is looking at a trade you've been watching. You said you were going to buy XYZ when it hit this level or when it broke out of this bullish chart pattern, but for whatever reason you didn't pull the trigger at the time. You second guessed it and then you watched the trade walk away from you. So you know what I'm talking about. If you've traded for any period of time, it happens to all of us. And discipline is an area where a lot of people who have skills, chart reading skills, intuition with the market, whatever, don't care how good you are at that. If you don't have the discipline in trading or investing, in my opinion, you will not be successful. So this gives you discipline. Let's go to the example here. So this was the last trade closed out on right side of the chart. Back on, let's see, February 12th, I put out alert. And one thing, just if you're not a member of the site, what makes us different from a lot of other websites is we don't just share trade ideas. I don't just tell you what I like and what I think might go up or down. That's all part of the free market analysis on the YouTube channel and on the website. But subscribers have access to the trade ideas, and that's where the money's made. And what we do differently, at least from the majority of sites out there, is I will list explicit price targets, and I study the charts in detail. I make I put a lot of effort into trying to identify the level where we'll max out the most of the run on each move, and I also provide suggested stops. Those are based, of course, as I say, that's based if you're targeting the final target. And the reason we have multiple targets, take a look at the FAQ page. I don't want to get too far off topic here, but the gist of it is everybody has different trading styles. Some people are very active and nimble traders like myself, and they may try to game the counter trend bounces when you look at each target. So if you read up on the FAQ page, you'll read the reason I have multiple targets are those are levels. Each target is a level where I think the odds for reaction, meaning a pullback or consolidation, is pretty good. So an active trader can try to game the rips and dips. So if you went long here like we did, short it or close your position at T1, take profits, and then buy back in on a pullback to support for the next ride up to T2. Likewise, take profits there, recycle back in, and then go to T3. And if that's the case, you would have done a lot better than the 7% or so that we made from buying right here on this pull. Oh, no, we bought here and then sold there. Now, where these OCOs come in, let's take a look. All right, so this was the entry on the trade. You can see it's the whole second mouse gets the cheese kind of thing. Those that bought in on the first dip saw it rally, got excited, but they probably had their stops run there. So at this point, once that divergent low, that second divergent low, or the divergent low, second low that undercut the previous lows that I was looking for at this time was in, we had confirmed divergence. We had a bullish falling wedge. You can see a nice trend line break. Big impulsive candle. I didn't want to chase it right there, so we waited for the pullback to support, nailed the entry right there, and then boom, we nailed the exit just yesterday, I believe it was. So this was the next chart when T1 was hit. There it was. We hit the first target for a quick gain, and then we go to the next chart here. This is T2 was hit just a few days later, and if you look closely, now keep in mind when you're on the site, right side of the chart, on a computer, you can pan and zoom all the charts once you expand them. So you can see when that first target was hit right there, you can see the pullback. It pulled back to just above that resistance zone. So that's what I'm talking about the reactions off T1, T2. You don't always get them. You need to really confirm that on the intraday charts. And again, that's off topic here, 5-minute charts, shorter term charts. Sometimes you can blast right on through a target and go on to the next one. But in this case, you can see as this trade panned out, and as I listed at the time, that there was a very good chance. I said active traders might consider booking full or partial profits and raising stops as a pullback is likely. And we go on to the next one, and you can see there was T2 right here. That was where we were just at on the previous chart, and sure enough, we did pull back. We had another thrust and another pullback. Then we powered on up. And this is what would shake a lot of people out, this back and forth action. And that's just the nature of the beast now that the volatility trade is busted, the short volatility trade in the markets. So you can expect a lot more of this back and forth stuff, and it will mess with a lot of people's head and make you second guess. So again, if your plan was to go long when we did and hold out for that third and final target, you simply do this. Let's pull it. Okay, here's how you would fill that order out. Again, you went long, you've got the email. If you're a member of the subscriber to the site, an email goes out immediately as soon as some entries we have ahead of time as a setup. If a stock breaks above a certain level, then we have a buy trigger. Price targets and stops are given in advance. You can wait to buy then, or sometimes I'll just, quick moving market. I see an opportunity. As soon as I can screenshot that post, get the annotations on it, I send out post it on the front page, and subscribers get an email right away. So had you bought there or anywhere abouts, then what you would do is turn around and enter an OCO order. So let's say in this example, you bought 100 shares of SPY. You're going to turn around and create two orders. One will be to sell whatever position you had, a limit order at your price target. In this case, the final target was set at 279.92 from the moment we entered that trade. So that's what you would put your limit price. Again, if you were targeting that. Very, very important. Make sure that you change the time in force to a good to cancel order, unless you've done so already. What I mean by that, most brokerage platforms will default to a day order, and therefore this order, as well as the one down below, if that's how you entered it, would cancel at the end of that day. So in other words, you bought here, by the end of the close that day, your order would have expired. So you can either go into your settings at your broker. Most brokerage platforms will allow you to change your default setting every time you place an order to good to cancel. It's up to you. But again, if you leave it a day order, it's going to cancel. So very important right there. By the way, good to cancel orders are usually good. They go out a few months. I don't know, I think it's like 3 months, and then they expire. That's just an industry standard, so you don't have orders hanging on there indefinitely. But you'll usually get an email from your broker or some type of notification that your order is about to expire if you're in the trade. Most of our trades are closed out. Majority of our swing trades are closed out in less than 3 months, usually well below that. All right, so there's your profit target order, and then the other side, order B, will be your stop loss order. Same thing, share, the symbol, the number of shares that you have on your position. You can get fancy with these orders. You can sell half your position at T2 if you want. So you'd sell 50 shares and then have another order there. Again, a lot of the brokers have a lot of flexibility with these what they call advanced order systems, order entry systems, but that was a stop on our trade was placed on any move above or below 256.90, which is a print of 256.89. So that's it. So you have a sell limit order here, stop loss there, and it's as simple as that. One or the other will be hit and the other will cancel. In this case, we get a check mark. We hit our profit target, and the system then would have automatically turned around and canceled this order for you automatically. And it doesn't get much easier than that. So again, you have the discipline and the convenience that you don't have to be in front of your desk. Because if we look what happened, and you can see what happened again each time these other targets were hit, we immediately pulled back the 60-minute candles. There was one tag, and that was about it. And then we had some pretty decent pullbacks. So you had to be quick to get out if that was your price target. Otherwise, you gave back. You didn't maximize your profits on the trade, whether you were going for any or all of these targets. Some people will scale out of a position. Others might just hold out for the whole thing. And just look at where we are today. So this was that same trade again. We entered back here on this pullback to support, and you can see we got out of there with hardly leaving any meat on the bone, and then market went on to reverse. I mentioned in yesterday's video to watch these lines for a breakdown. We broke down, and I posted before the close under that video on the site yesterday that before the close that we were almost certain to print daily closes below those trend lines, which meant more downside in the this week. And so far, of course, we were down today by another 0.5% or so on the SPY. As I said, there's a lot of bells and whistles or different options with the conditional order types. If you want to keep it very simple, you can kill all three birds in one stone, both your entry as well as an OCO order. So what we're looking at here, and again, every broker might use a different term. Most brokers should offer something similar. This just happens to be through Fidelity's platform because it's easy to show on the video. That's not my go-to trading account, but I do like it's a simple order entry screen for most to figure out. So you just go to conditional orders there, and then you would select a one triggers. Oh, I missed that with the circle. Oh, just get rid of it. You can see it there. One triggers, a one cancels the other. So basically, you have order A up top here, order A, and it says if this primary order executes, trigger orders B and C below. So in this case, I'll just show you the real world example here. It's going to be a little squished down on this screen, but basically you have three orders. So had you gotten the alert that day to the buy signal on the official trade for SPY, again, you would enter buy 100 shares of SPY at the market. And immediately on submitting that order, just below the screen here, I'd have to move it for you. I can do that. There's a preview order button, then you send it. So what that'll do is you'll send it, you'll buy it at market, and then it will automatically submit that OCO order for you to sell at your profit target right here, sell limit, or a stop loss order to protect your downside. So one single click, submit that order, it'll buy SPY for you or whatever you're buying, and it'll turn around and protect you on the downside with your stop loss order, as well as make sure that you are filled if that stop or that trade of yours hits your preferred profit target or profit targets. And it really doesn't get much easier than that. And again, if nothing else, it's the discipline of it that I think is just as convenient or just as beneficial, I should say, to those of you that don't have the time to stand in front of the computer, especially in a fast moving market. Because a lot of the trade ideas on the right side of the chart, they're explosive and they move quick when they break out. And a lot of them, when they hit a final target or any of the targets, they can pull back very quickly too. So you don't have time to come home from work at 5 o'clock or whatever it is, and turn on the computer and check and see, oh well, wow, my second target was hit. By the time you saw that and got home, you already had a pretty big give back on that trade. So hopefully this helps. And again, this will go in the educational section on the YouTube channel. And when I get a chance, I'll try to put this in writing. I know some of you prefer a quick written video. I can take these screenshots that I've taken here, and I'll put that on right side of the chart under the educational post categories. This has been Randy Finney with Right Side of the Chart. And as always, if you enjoyed the video, please give me a thumbs up on YouTube. Have a great day.